In the recent years, we have seen some crazy gains in stocks like Tesla, Roku, Square, Shopify, Etsy, and many more. A lot of analysts have questioned their valuation and argue it is a matter of time before these come back to earth. These analysts have been wrong for a while now. I think they'll continue to be wrong. These stocks will continue to grind higher, challenging the thesis of valuation. Let me explain why. By the way, I won't be surprised if I get a lot of hate comments on this video, but my goal is to share my perspective. I think a lot of investors out there, myself included, have been influenced by the valuation story and missed out on some of the biggest gains out there. What's happening, everyone? Welcome to Think Finance. My name is Raj, and on this channel, I talk about personal finance, investment ideas, money management tips, and everything money. In this video, I want to talk about why valuation is dead for now, and why some of the momentum names will continue to grind higher. This concept of valuation is dead was discussed heavily during the dot-com era and also in the 2000s. I'm going to use the popular phrase. This time it's different, and why I think popular momentum names will continue to go higher with some bumps on the way. Let's talk about a few stocks: Tesla, Roku, Square, Shopify, Amazon, and Etsy. In the last 5 years, Nasdaq has returned around 200%. In the same period, Shopify has returned over 5,300%. Tesla is at 2,400%. And all throughout this period, most analysts have asked you not to invest in these names since the valuation is stretched. And it is a matter of time before these come crashing. These stocks continue to defy gravity. History does support the argument. Historically, value stocks have outperformed growth stocks. Over the last 90 years, value stocks have outperformed growth stocks by an average 4.4% per year. However, things are different in the last 10 to 15 years where growth has significantly outperformed. Let's talk about valuation a bit. Valuation is measured in terms of multiple. Price to earning, or PE ratio, is one such multiple. PE is probably not the best metric to evaluate growth companies. Price earnings to growth, or PEG ratio, is a better metric that takes into account the EPS growth, which is more relevant for growth companies. For example, PE ratio for Amazon is 90 and PEG ratio is 4. Lower number is considered a better buy. But of course, metric on its own mean nothing. Compare Amazon to average multiple for Nasdaq, and suddenly Amazon looks way overvalued. Indeed, all momentum stocks will look overvalued, and it's been like this for years. But what's also true is that they continue to outperform the broader market by a wide margin. The issue with PE, PEG, and other multiples is most miss the exponential growth and any innovation these companies are capable of delivering. Most of these companies are young and have so much room for innovation and growth, which most analysts will fail to see. Does that mean you should ignore valuation completely? Not really. It still makes sense, but it is probably more accurate for value or stable stocks, which have more predictability. I don't think you need to treat valuation more than just a data point when it comes to cyclical or growth names. This should not be something that you live by for making buying or selling decisions. let's park this for a minute and talk about how trading has evolved over the years. I promise I will connect these pieces together and share my thoughts on why it makes sense to accumulate some of these growth stories. I don't know about you guys, but when I started trading, things were slow, expensive, and I needed a computer to trade. Years back, I started with Scottrade and their marketing pitch was $7 per trade. $7 commission when you buy and when you sell. $14 to complete a trade. While they had a website, I remember in the early stages, I had to go to a local branch to deposit new money into my account. Took at least 3 days to clear. Withdrawal took days to clear as well. At least I didn't have to make a call to place a trade. Today, things are different. Anyone with a phone can trade for free in minutes. I think fractional stocks and commission-free trading is revolutionary. I know some people will buy any dip on their favorite stocks. Tesla dropped 6%. Yay, let's buy some more. And you can buy just a little bit, maybe worth $50. There are 13 million Robinhood users who do this every day. According to SoFi, fractional trades represent 35% of all stock buys, with Amazon, Tesla, Apple, Disney, and Microsoft. Point being, retail investing has changed drastically. In a bull run with fractional investing and commission-free trading, these retail investors keep pushing momentum stocks higher. Final point, we are experiencing a change in how some of the notable money managers and analysts think. Take a look at this video where Gene talks about the EV space.
Becky, I want to start with an important learning that I've had in tracking these transformational tech themes, and it's they tend to take much longer than we anticipate to come to fruition, but in the end, they end to be much bigger than what we ever could have imagined. And I think a great textbook example, and I think an indicator about how to think about the EV market is think about what happened in Amazon. It went from $3 to $90, from 97 to 2000, and then it blew up and went to $7. Today, of course, it's $3,100. Perfect use case. And so when I put this together and think about EV and autonomy, this is a massive market. It's the transportation market, car market's $2 trillion, the broader transportation is additional $2 trillion. We're talking $4 trillion. That compares to the smartphone market at $500 billion. So it's understandable, the enthusiasm around these stocks. I just caution that this will take longer than people think. And I would put it all together, Becky, and say this. If you're trading these stocks for a 1-year time horizon, that is a dangerous endeavor. Ultimately, if you're investing in these companies for 3+ years, that's wise.
He talks about a few things. Transformational tech will take longer, but will get bigger than anyone can ever imagine. And you need to think longer term. Most of the companies that are driving innovation are misunderstood today. Gene talks about Amazon, which was a loss-making company for the longest time, and no one really understood Jeff's vision. We all know where Amazon is today. How many analysts out there still compare Tesla to Toyota, Ford, and other car companies, when Tesla is more than just that? Energy storage, solar, AI, autonomous, and more. It takes time to understand innovation, and when most of us finally get it, it might be too late and stock may have had its run already. You want to catch innovation at its infancy and not get distracted by flawed valuation calls, since it is impossible to value innovation. Now that is a bold statement. Cathie Wood is another example. She believes in innovation and is always looking for companies that are primed for exponential growth. Take a look at this video where I talk more about Cathie's company, ARK Invest. I'm also seeing some new ETFs that are focusing on innovation. Here is an ETF from Direxion. They call it the Moonshot Innovators ETF. Look at the themes: genetic engineering, cybersecurity, autonomous, virtual reality, space, internet. Compare these to ARK ETFs. Focus is again innovation. So does this mean you should dump value, defensive, dividend, and stable names and go all in with growth and innovative names? Not really. Here's my 2 cents. In a bull market, popular stocks will continue to go higher. These stocks have a fan following. There is something emotional about them, and retail investors continue to buy dips. And with support from notable money managers like Gene and Kathy, it acts as a form of validation. Example, Tesla and Roku, which means there is no stopping for some of these stocks. Of course, don't buy the top 100 Robinhood stocks. Understand where you're investing. Along the way, we will see corrections. And if we hit another bear market, these will get killed, only to give us another opportunity to buy more. I'm guilty of this as well, but I don't think we should limit ourselves from all the valuation talk that you hear on CNBC. Focus on exponential gains and the long-term price. Having said that, I do think we should have a balanced approach with a mix of traditional stocks and hypergrowth stocks and ETFs. Also, don't FOMO into these stocks. Fear of missing out. There will always be another opportunity to accumulate. As always, stagger your buying. Invest consistently, weekly, monthly, whatever works for you, and invest automatically. By the way, my portfolio includes 20% ARK ETFs and also stocks like Tesla, Shopify, Etsy, and few others to cover innovation. More on this in these videos. There's a link in the description if you want to follow my portfolio on M1 or open a new account. What do you guys think? Do you guys live by valuation? Thanks for watching. Like, subscribe. Until next time, peace.